An earnings report is like a school report card, but for a company. It tells how well a company has done in the last few months, usually every 3 months. Just like a student gets grades for different subjects, companies share numbers for different parts of their business. This includes how much money they made, called revenue, how much they spent, and how much profit they earned. Most public companies release these reports 4 times a year. These are called quarterly earnings reports. They are shared with the public so that investors, analysts, and regular people like us can see how the company is doing. The reports usually include a written letter from the CEO or company leaders, some charts or tables, and important numbers that show the company's performance. Why does this matter to you? Because if you're thinking about buying a stock, you want to know if that company is doing well or not. A strong earnings report might mean the company is growing and could be a good investment. A weak report could be a warning sign. So, before picking any stock, you should always check the company's earnings report. It gives you the real facts behind the stock price. Why earnings reports matter? Earnings reports matter because they show the true health of a company. While stock prices can go up and down for many reasons, like news, trends, or rumors, the earnings report shows the real numbers. It tells you whether the company is actually making money or just looking good on the outside. When a company releases its earnings report, investors and analysts look at it closely. They compare the new numbers with the company's past performance and with what experts were expecting. If the company earns more than expected, its stock price might go up. But if it earns less, the price might drop. This is why you'll often see big moves in stock prices right after an earnings report comes out. For people who want to buy or sell stocks, these reports are a powerful tool. They help you make smarter decisions instead of just guessing. You can see if a company is growing, if it's cutting costs, or if it's facing problems. Think of the earnings report as the truth behind the stock. It cuts through the noise and gives you real information. If you want to pick winning stocks, understanding and using earnings reports is one of the best things you can do. Always look beyond the headlines. Go straight to the numbers. Key numbers to look for. When you open an earnings report, it may look confusing at first. But you don't need to be a financial expert to understand it. You just need to focus on a few key numbers that tell you how the company is doing. The first number to check is revenue. This is the total money the company made during the period. It's also called sales, or top line. If revenue is growing compared to past quarters, that's usually a good sign. Next is net income, also known as the bottom line. This is the profit left after paying all expenses, including salaries, taxes, and bills. If a company is making more net income over time, it means it's managing its business well. Another key number is EPS, or earnings per share. This shows how much profit each share of the company earned. Investors often use EPS to compare companies of different sizes. If EPS is going up, it can lead to higher stock prices. Also, look at operating margin. This shows how much profit the company keeps from each dollar of sales before taxes and interest. A strong margin means the company runs efficiently. These numbers are like the heartbeat of a company. When you learn to read them, you can spot strong companies and avoid weak ones. Keep it simple, stay focused, and you'll start seeing patterns that help you pick better stocks. Understanding revenue and profit are two of the most important parts of an earnings report, but many beginners mix them up. Let's break them down in simple terms. Revenue is the total amount of money a company brings in from selling its products or services. It's the first number you'll usually see in an earnings report, and it's often called the top line. This number shows how much business the company is doing. For example, if a company sells phones, revenue tells you how much money they made from all the phones they sold. Profit, on the other hand, is what the company keeps after paying all its bills, like rent, employee salaries, raw materials, and taxes. This is also called net income and is known as the bottom line. A company can have high revenue but still make little or no profit if its costs are too high. It's important to look at both numbers. A growing revenue shows the company is selling more or increasing prices. A growing profit shows the company is managing its costs well. Sometimes, a company might report high revenue but falling profit. That could be a red flag. Or profit might rise even if revenue stays flat. That means they're cutting costs. Always check the relationship between the two. This helps you understand if the company is truly growing or just getting by. What EPS really tells you: EPS stands for earnings per share, and it's one of the most watched numbers in an earnings report. But what does it really mean? In simple terms, EPS tells you how much money the company made for each share of its stock. It's calculated by taking the net profits after all expenses and taxes and dividing it by the number of shares the company has. For example, if a company made 10 million and has 5 million shares, the EPS would be 2.0. Why does this matter? Because EPS gives you a clearer picture of how much value the company is creating for its shareholders. A rising EPS usually means the company is growing and becoming more profitable. And when EPS beats what analysts expected, the stock price often goes up. But don't just look at the number by itself. Always compare it to the previous quarter or the same quarter last year. Is it going up or down? A consistent increase in EPS over time is a strong sign that the company is doing well. Also, check if the company is buying back its own shares. This can make the EPS look better even if profits stay the same. That's why it's smart to look at the full picture, not just one number. EPS is a simple yet powerful way to judge a company's financial strength. If you understand it, you're already one step ahead in picking better stocks. How to spot red flags. Not every earnings report tells a happy story. Some reports hide problems behind big numbers and fancy words. That's why it's important to learn how to spot red flags, warning signs that a company may be struggling. One major red flag is declining revenue. If a company is making less money than before, it could mean fewer customers, falling demand, or strong competition. Even if profit looks fine, falling revenue is something to watch closely. Another red flag is shrinking profit margins. If a company's costs are rising faster than its sales, it might be losing control of its expenses. This shows up when net income drops even if revenue stays the same. Watch out for high debt levels too. If a company is borrowing too much money, it might face trouble if interest rates rise or if its business slows down. You can usually find this in the balance sheet section of the report. Also, be cautious if a company gives unclear or overly positive guidance without strong numbers to back it up. Vague language may be used to distract from weak results. Finally, compare the company's current earnings to analyst expectations. If it misses the estimates by a lot, it could shake investor confidence and hurt the stock price. Looking at growth trends when reading an earnings report, one of the smartest things you can do is look for growth trends. A single good quarter might not mean much, but steady growth over time tells you the company is moving in the right direction. Start by comparing the company's current earnings report to the same quarter last year. This is called year-over-year growth. If revenue, profit, or EPS has increased compared to last year's numbers, that's usually a positive sign. It shows the company is not just lucky for one quarter, it's growing over time. Also check for quarter-over-quarter changes. This means comparing this quarter to the one just before it. While it's normal for some businesses to have seasonal ups and downs, a company that consistently shows better results each quarter is usually well managed. Growth trends also show up in things like customer numbers, new product sales, or expansion into new markets. Some companies even include graphs or charts in their reports that make these trends easy to spot. But be careful, not all growth is healthy. If a company grows fast but takes on too much debt or cuts corners, that can lead to trouble later. By following growth trends, you get a clearer picture of a company's long-term health, not just a quick snapshot. It helps you find winners that are likely to keep growing. Compare with market expectations. An earnings report is not judged by numbers alone. It's judged by how those numbers compare to what the market expected. Even if a company makes a profit, its stock can fall if it didn't meet Wall Street's forecasts. Before earnings are released, analysts predict things like revenue, EPS, and overall performance. These are called estimates. After the report is out, everyone compares the actual numbers to these estimates. If a company beats expectations, meaning it earned more than predicted, the stock price often goes up. This is called an earnings beat. But if the company misses expectations, even by a little, investors might lose confidence, and the stock price can drop. Sometimes, the report matches expectations exactly. In that case, the stock might not move much at all. That's why knowing the expected numbers before reading the report helps you understand the reaction afterward. Also pay attention to future guidance. This is when the company tells investors what it expects in the next quarter or year. If they predict strong future growth, the market may react positively, even if this quarter's results were just okay. Comparing with expectations gives context. It helps you know if the company is doing better, worse, or just as expected. This step is key in choosing smart, confident investments. Choosing the right stocks to buy. Now that you know how to read an earnings report, the next step is using that knowledge to pick winning stocks. The goal is simple: find companies that are growing, healthy, and likely to stay strong in the future. Start by choosing companies with consistent revenue and profit growth. These businesses are not just lucky, they are doing something right. Look for rising EPS, improving margins, and smart spending. Avoid companies with too much debt or unstable numbers. Also, pay attention to industry trends. Even a strong company may struggle if the whole industry is slowing down. Try to find businesses in growing sectors like technology, clean energy, or healthcare, areas where future demand is rising. Another tip is to check management commentary. Read or listen to what the company's leaders say about their plans. Are they clear, honest, and focused? Good leadership matters. Compare companies within the same sector. Use earnings reports to see who is leading and who is falling behind. Finally, don't rush. Picking the right stock takes time and patience. Use earnings reports as your guide, not just the headlines or hype. When you understand the numbers, you can invest with more confidence and less fear. That's how smart investors win.